All right, so when I was originally asked to come up here with Bob, by Bob, who invited me to come up here and do this, I was on the fence whether I was going to do this or not. My channel was born out of the silver squeeze movement in 2021, and I watched the price of silver rocket up. Oh, it was so great to watch. I was so enthusiastic about it. And then I watched it come right back down, and I watched the movement kind of fizzle out. It lost a lot of its momentum. And a lot of people came out of nowhere, self-included, through that event. And a lot of people did really well. A lot of people did not so well. And Bob was one of the few voices in the metal community through that whole experience that was willing to tell people things that they didn't want to hear at that moment. At that point in time, there was a lot of cheerleading going on in the metal space. And everybody just buy, make the number go, squeeze, smash the COMEX. Bob was one of the few voices that was willing to speak out against that grain, against some of the cheerleading, and try to inject a little bit of rationale into it. And it didn't really go over so well with a lot of people. And I'll give you credit for that, Bob. Telling people things they don't want to hear, it tends to come back at you, NVIDIA. I've gotten a lot of messages from a lot of the Robinhood bros who have been piling into NVIDIA stock, so I've seen some of that firsthand, and it can get pretty rough. But there is a wisdom in hearing that message. Take the time to listen to what you don't want to hear, because sometimes there's truth hidden in there, and some of the most dangerous knowledge are the things that you swear you know to be true that end up not being true. And Bob was trying to warn about a lot of this stuff during the silver squeeze. And so what we decided to do today, Bob wanted to talk about price discovery in precious metals. Now look, people who sell gold are businessmen, and I'm a diehard capitalist. The point is to make money, and there's nothing wrong with making money. That's what we're here to do, right? That's why we all do what we do. Through the silver squeeze, there were certain practices that emerged in some parts of the industry that took advantage of that enthusiasm and did really well and capitalized. And we saw things like premiums exploding higher, where, I always say when you buy metal, you don't spend money, you're just parking your wealth in precious metals. Okay. You spend money on premiums, you spend money on shipping, you spend money on storage and costs, but the metal itself, you're just parking your wealth there. And through the silver squeeze, we saw those premiums explode higher. So we're going to talk a little bit about some of the things that you can watch out for that can make you a better consumer, a better investor. There's nothing wrong with somebody making a profit when they sell you something, right? If people didn't make a profit when they sold you something, there would be no people to buy that thing from, right? It's like a car salesman. There's a lot of, like urban legends about the sleazy car salesman, right? They're notoriously greedy and they rip people off, but there are honest ones out there, and if they didn't make any money, there would be no car salesman to sell cars. We wouldn't be able to get a car. So we're going to talk a little bit about some of the pitfalls of buying precious metals, some of the things you can look out for that can make you a more informed consumer and make better decisions when you're buying your gold. And Bob has a long, storied history in this industry. So, Bob, tell us a little bit about your background, some of the businesses you run, and what it is that you do.
Sure, well, and I appreciate the opportunity. It's the third time I've been to the symposium, spoken each year, and then we decided to support the symposium a little bit more this year, and I appreciate Jack's willingness to do this type of style of interview, because I think instead of doing a presentation on charts and graphs and facts and figures, do something a little bit more interactive and a little bit more, I guess, on the edge of reality of the industry versus, and what I think all of us have experienced over the last 3 years. So sort of a where have we been, where we're at, where we're going to type of presentation, I guess you can call it. Just a little background on me. I've been an investment advisor since 1992. Started with Dean Witter in 93. Got taken over by Morgan Stanley. I ended up leaving in 98, started my own investment advisory company in 2001, started a hedge fund in 2001. By 2006, I saw the whole system basically leveraged up to the eyeballs, and I was like, I need to do something that gets clients' assets out of the system. So gold and silver made the most sense. I looked at every depository in the country at the time. None of them fit my risk parameters, so I ended up starting a depository company in 2008. which is Idaho Armored Vaults. And then 2010, we went into operation. We are now storing close between 650 and 700 million in precious metal assets. One of the largest depositories in the country. Everything's fully segregated, fully insured by Lloyd's of London. We also do full armored logistics as well. So we have our own armored fleet. We can move up to 10 million in the vehicle. We also do courier as well as freight coverage and transportation as well. Also have a facility in Singapore we store metals in, but since COVID, we've been pulling that back. On top of all that, I also buy and sell metals with wholesalers. I'm a little bit different because I don't really call myself a dealer. I don't take inventory, but what I do is I go to the wholesalers and buy when the client needs it. So we are able to save an absolute fortune on premiums amongst the traditional dealer model. Because I'm a depository, I'm the only depository in the country that's not owned by a gold dealer, financial institution, or cash in transit company like a Brinks. So the depository is a full positive cash flow going concern. And that's our bread and butter. And getting metals for clients, we don't need to have huge markups and pay the overhead and so forth, so we pass along the savings. That gives you a little bit of what I do. Again, I run a hedge fund, so it makes me a little bit different with regard to, it's focused on precious metals, but that's just for full disclosure. I'm not trying to solicit the fund at all. Roughly, the assets are about 99.4% in physical metals stored at our vault, and I'm roughly about 70% weighting to silver, 30% weighting to gold. So a little bit, and I also do stuff on Twitter. Profits Plus ID is my I guess account or whatever they call it nowadays on Twitter or X or whatever. But I put out a lot of good information, try to cover gamuts of price action, what's happening in the industry, what's going on, explaining to people how ETFs work, how structured programs work, what to watch out for with storing metals, getting involved in different types of digital programs or other types of allocated or pooled programs, trying to help people just understand what they're investing in. A lot of people don't tend to read these user agreements, and I do.
So user agreements, that's an interesting topic because a lot of people, you just check the box, okay, yeah, whatever, just give me my metal, and you don't realize you just signed away all your ownership and your claims and everything when you check that box. Another few things up front. When we agreed to do this, I've made enough enemies recently with some of the stuff I've been talking about on my channel, so I didn't want to come up here and make more enemies. So this isn't a session to badmouth competition. We're not going to call out specific companies and say these guys are crooks and this is what they do. It's about things to watch out for, pitfalls of investing in metal, right? Because they make money by charging a fee, by charging a premium, and that's the price that you pay. So Bob, tell me a little bit about what are some of the things that you saw, maybe even during the silver squeeze in particular, that you saw that maybe people need to watch out for? What are some of the things that could be hiding in those user agreements or some of the practices that you see?
Yeah, a lot of it, I've done a lot of, I guess, YouTube videos with Palisade Gold Radio, talked about a lot of different programs, the types of clauses that they use. You'll see a lot of limit of liability restrictions within these agreements that basically negate the responsibility of the program itself. If you're invested in some type of allocated or pooled program and they use the word digital, what you really own is digital metal. That's what they typically claim. And so they'll define actually what you technically own. And so what a program will do is they'll claim that you own physical metal, but in reality, the physical metal backs the digital metal, but you don't have any claim on the physical metal itself, because a lot of times these programs, especially these pooled programs, will use your money to buy metal and then recirculate that metal for their own purpose to maybe make take 1,000-ounce bars, make 1-ounce rounds out of it or whatever it may be, and then go ahead and recirculate with those profits. They'll go ahead and buy 1,000-ounce bars again. And so in essence, they represent that they are responsible for, if you want to take delivery, or in a lot of cases, you can't take delivery of the metal that's actually in the pool. You have to get upcharged and buy a specific product and then pay another commission on top of the transaction fee that you paid to get into the program. And so trying to understand those types of things, and this is, obviously, you could go a deep dive into this stuff, but
could we elaborate a little bit about that? Because there's a lot of platforms out there that offer things that you just said. The digital claim on the gold, where you've got so many ounces in your account, you log into the app, there's your ounces in your account, but then that actually a specific ounce doesn't exist somewhere, does it? And if you want to take that ounce, take delivery on it, you get routed to another website where now you have to pick out, say, a gold eagle or a 1 ounce gold bar. All of a sudden you've got less ounces. You just paid premium, didn't you? Your premium just went up, and you didn't actually pay it until you tried to take possession of it. Now, where would you see that? Is that a specific line of text or something, some phrase you want to look out for in the user agreements when you sign up for a program like that?
Yeah, I mean, those are all in sort of the operational clauses within the agreement of how you actually can either take delivery or exit the program, so to speak. So a lot of times you can just sell out of the asset itself or out of the program, and then you sell it, whatever the spread is of the charge to get out of the program. But if you wanted to upgrade to, like you said, silver eagles or gold, silver rounds, whatever it may be, you'll then have to pay that upcharge to get out. Now, what's interesting is a lot of these programs aren't, especially the pooled programs, there are programs out there that's probably people in this audience already own, where, for example, and I won't name names, but one of the programs, at least 10% of their metal is in Russian hallmarked LBMA restricted bars. So the question you run into is, and this is a very popular program, it's all over YouTube and so forth, but the question you have is liquidity. If obviously, this Russian thing, with the Ukraine and all that escalates, whatever it may be, they have silver, but the silver is somewhat, I don't want to say tainted, but it's restricted, meaning it may not go for the same price as a PAMP Swiss bar or as a Johnson Matthey bar, because these are all restricted Russian refinery bars. Even though maybe the day before Russia invaded Ukraine, these were trading fine on the COMEX, now these aren't as maybe marketable. So these are things that clients probably don't even know that the program that they're invested in even has that type of exposure.
So if you see a certain bar on a website that's for sale at a much smaller premium, maybe that's just something you want to go make sure that wasn't sourced from a company that's now sanctioned, and if you go to sell that bar, your potential market for selling that bar is smaller because anybody who doesn't want to run afoul of U.S. sanctions would never buy that from you. So the demand for that bar is less. You may end up paying for that on the back end, so you're not really getting a better deal when you buy that one, are you?
Right, and so the way these programs have operated the last 3 years is the premiums have been really high, and so they come up with these programs to say, listen, you can get involved in physical metal at a fraction of the cost, but in reality what you own is a fraction of a bar and not really any metal itself. You don't have any type of bailment agreement or clause. So for example, if a program went under, typically if you own that metal's set aside, and then that gets basically washed and then ultimately into your hands. But in this type of situation, you're actually a creditor, and that's the reason for all these limited liability clauses that restrict your recourse.
Now, I know one of the things you wanted to talk about a lot was American Silver Eagles, the ASEs. We saw earlier this year, the premiums on those things blew out. They were almost trading at twice spot. I mean, spot was around $22, $23, and yet an American Silver Eagle was almost $40. What is going on? Why did the premiums blow out like they did on ASEs?
Well, I think you have to go back to 2018-19 when the metals markets, you couldn't give a bar or coin away. It was just, there was no interest in the metals. And you had a lot of production, a reduction of production going on in the industry itself. So when 2020 and COVID came along and the EFP blew out and the London market froze up because you couldn't get physical metal, and all of a sudden everyone was covering their shorts on the COMEX, and the gold went to a $75 premium to London pricing. All of a sudden, the retail dealers, I started to see this on their websites, their spot price that they advertised to buy metal at was much higher than the London spot price itself. So a lot of times people were paying 30 or 40 cents extra for something that's advertised as spot price, but in reality, that was just the dealer's own markup. And it's the same thing for gold as well. So there was a little bit of, say, profiting from that side. And then on top of that, all of a sudden you got this sort of wave of public demand for the precious metals, which created this real tightness in the market. And what basically retail dealers did was, and promoters and so forth, started yelling the term shortages. That started coming up everywhere. And so it got the public, the moment you can't have something, that's what you want it the most. And so all of a sudden it's like throwing gasoline on a fire. That created more of a panic to buy metals, and the industry was just shell-shocked. Everything was shut down because of COVID, you had social distancing and all that kind of stuff. So what really became looking like a shortage of metal was just simply a delay in production schedules. And you just had to wait a little bit longer to get metal. And so, some people, they panicked and they said, I'll pay whatever price, which is fine. And dealers have every opportunity to make money. The question is, when did this go from simply a sort of a mad rush until the industry really did take advantage of the situation and started really profiting? Because basically when you buy from the U.S. Mint, if you're a direct distributor for the U.S. Mint, you're paying $2.95 over spot. Why the distributors for these U.S. mints were charging on the wholesale side as much as $10, $12 over spot is beyond me. And then it gets to the retail dealer, and then they mark it up another $5 or whatever it may be for their profit margins. And so by the time the client actually buys the metal, it's not an investment anymore. It's basically like a teacup you bought from Walmart. I mean, silver has to double in price just for you to break even. And I was out there on Twitter saying, be very careful because these premiums are going to crash. They're going to come down. I did a Spaces. It was like 5 hours long, November of last year, right after there was a Zero Hedge article with a couple of big name gold dealers mentioned in the article, like you gotta buy the metals, the train's leaving the station, and all that kind of stuff. I was saying no, the premiums are going to peak here because what's going to happen is if the price keeps going up, you're going to get secondary supply eventually coming to the market. Well, what ended up happening is the premiums did peak. They had a little bit of rebound in March because of the banking crisis, and now they've just pancaked. I mean, we put premiums up on our website for a reason. One is for transparency, so people can actually see what's actually going on in the marketplace. The bids have, what dealers were charging for Silver Eagles $18 over spot. Now they're buying them back for maybe $1 or $2. So now the client who bought at that really high price is going to have to overcome a massive amount of spread risk. And then, of course, you have silver maples. We sell silver maples for $3.10 over spot or something like that. Dealers were selling them for $12 over spot. And the bids on those things, they've come down as well. But what I try to do is say, listen, if you're trying to get the mass audience into the physical metals, you got to give them the opportunity to make money, not just sell them an insurance policy that says, listen, unless the end of the world happens, you're never going to make money on this thing. I mean, if we can do that, we're going to take money that would go normally into metals that like institutions and high net worth individuals would spend it on ETFs because they say, well, I can buy and sell and get in and out and I don't have the spread risk. But if you can make this a much more feasible product to actually make money in, I think the industry would benefit. And on top of that, you would actually take more price action or discovery away from the paper markets and shift it into the physical market.
Excellent. Now, you mentioned before about the markups on spot, that you've seen some dealers, they just tweak spot a little bit. So they didn't actually raise their premiums, they just adjusted the spot a little higher to make hiding the raised premium. Where would you go to verify? Say you suspect that might be going on. What would you use as your barometer of spot price to go see if that was happening?
The website that I use, and I've used it for a long time, it's absolutely free, is netdania.com, netdania.com. Totally free. They give you free streaming London spot prices. It's the CEFD market, so it's cash for differences market, but it's a really tight spread. The wholesalers, their pricing is based right off of that. It's a little bit, just a hair bit wider, but that'll give you a real good indication of what the London market is actually doing, and it's streaming, so it moves 24 hours a day.
So you would expect maybe every dealer's price is not going to line up exactly with that because their internet might be a few seconds or a few minutes slower, the site doesn't update, but you would typically see a spread, of a couple of cents? What you see on the dealer website should be within a nickel or within a dime of that? Or
Yeah, typically in the wholesalers, they're within about 2 or 3 cents on silver and within about $1 off that interbank market quote that you see on NetDania. But when you get to the retail side, it's maybe 25 cents wider, and that's not really discussed or disclosed, on the website itself. And I think last year I sponsored. I had Matthew Hunter come in. He was with the CFTC, ran the enforcement division. And we kind of went through a lot of these scenarios at the Silver Symposium last year. But his thing is, well, the spot price is really, there's no technically term defined spot price anywhere in the world. So really, in essence, that spot price could be someone else's opinion of the spot price. It could be the London market, or it could be the cash market, that's traded on the COMEX.
Now, this is something that's a pet peeve of mine. Pre-sales, all right? We tend to see pre-sales pop up, especially during those moments of FOMO, right? When the premiums spike, all of a sudden you're going to see, okay, we're out of stock on this, but you can pre-sale it now and you'll take delivery in 8 weeks. That's a short, isn't it?
Well, the CFTC has a rule that says in the physical market, paid for in cash, that you have 28 days to deliver the metal once the client pays for the transaction. So once the transaction is settled, the dealer has 28 days to deliver. Otherwise, what happens is that becomes potentially like a forward contract or something of that nature. And so the industry, the wholesale industry, is very, very sensitive to not selling product that they know they can't get within that 4-week time frame. Which I don't know how the last 3 years, obviously I've heard stories where people were waiting 2 months, 3 months to get physical delivery. So you're right, that was basically pre-sales. And of course then they would, you'd see a lot of this hype of, okay, I had to order this thing, from the mints, 2 months in advance just to get some type, because the demand's so strong. And those are all marketing type of tactics to get people to realize, oh my God, I got to buy this stuff because it's going to run off the shelf. But in reality, it was never on the shelf to begin with. It was always just, like you said, a pre-order.
So the dealer is selling something to you. He's locking in those high premiums during those periods of FOMO, knowing those premiums are going to come down. So he sells you a pre-sale now. He gets his premium, delivers the metal a few weeks.
Or worse, the premiums were never high to begin with, but because of the FOMO, they were able to get more premium. We saw this when the first bank went down in March, and yes, there was a mad rush of people coming into the market, but we saw premiums just explode because prior to that bank going down, you had a lot of loss of interest in the physical metals market. So physical metals markets work more on an event-driven type of mentality. So it waits for something big to happen and then people rush in. Or you get a big drop in the market and you get a buy in the dip. That's how the industry sort of practices with or interacts with the consumer. What I've been trying to tell the industry is instead of jamming these premiums higher, try to level this thing out more and allow a wider audience to gain some type of traction with.
So allow a wider audience to come in, because when people eat $20 premiums on American Silver Eagles and then they get home and they realize they get their metal, I like it, and then you realize metal has to double for me to break even, right? That's something you've driven somebody out of the metal space now once they realize that's happened, that they may not, that you've funded the premiums, you haven't pulled as much metal off of the market, you haven't contributed to the demand for the metal as much, you've just inflated profits for the dealer, is what you've done. Now, you talked a little bit about some of the imaginative marketing tactics, stuff to watch out for, and this is where it can probably get a little bit fun. How would somebody know they're experiencing imaginative marketing, as you put it? What's that going to look like?
Well, I mean, I've had clients call me and go, we got 2 weeks to get out of the banks because they're going to collapse. And then I said, well, where did you hear that from? They said, well, someone on YouTube, but they said I had to pay $2,500 to actually get the full story. Things like that, and I know, we all understand that the system is highly leveraged. At some point you're going to have a massive, I guess, event, you could say, and obviously the Fed's going to have to come to the rescue, print even more money, and that's why we actually buy the metals, because we believe that, okay, this will at least hold my purchasing power. The problem we run into is the dealers the last 3 years have had a massive pricing power over the consumer, and what has turned out to be people trying to protect their purchasing power, what they ended up doing was paying for something very overpriced, and now they almost need the market to double just to make some type of rate of return. And that's the unfortunate thing that I think a lot of people that I've talked to in the last 3 months have been very frustrated. The dealer community has been seeing more sellbacks into the market. People are saying, listen, this hasn't worked out, or I can get 5.5% in T-bills, or there's more competition for gold and silver right now, and there just hasn't been any event. It's just been fairly quiet, even though you had the BRICS thing, and then you had a lot of promoters talking about how the BRICS currencies are going to overtake the dollar, and I'm sitting there going, my God, you have like a company like, well, I don't want to say the name, but very well-known structured product company make an acquisition, sell a bunch of their gold and silver on their balance sheet, not the client's money, but their own balance sheet, and bought a commercial real estate with it, investment, tells me that even the industry doesn't believe that there's maybe, doesn't believe the FOMO that they're practicing to their client base. And that's, part of me says there has to be more transparency. The consumer deserves to understand what these practices are doing and how these members are managing money themselves. Because I did a question on Twitter one time, and I said, would most of these dealers be buying precious metals at the prices that they sell them for? And I would doubt it. That's a true litmus test.
Now, you've got a new platform coming out, and you don't spend a lot of money on advertising, right? And by the way, this is not a paid advertisement. I'm not being paid to be up here. You see the premiums. You see they've moved too high. And you're telling me your premiums, you're going to be able to beat pretty much everybody on the street because you don't pump money into advertising. Yeah. And you don't see ads for Idaho Armored Vaults when you're on Yahoo Finance, and that's funding the premium. So what do you have coming out, Bob?
Well, I got a chart that actually has has the premiums right there. So that's as of, I think, Wednesday's updating. So you can kind of see what we sell product for every day. These aren't specials. This is just everyday pricing. And this is all over spot. And again, refer to, roughly the Netdania quotes on spot, not the stuff that you see on a lot of big online retail dealers. But it gives people an opportunity. Even if you like your dealer and you want to stay with your dealer, that's great. But use this as a way to maybe negotiate with your dealer and say, listen, I can get it from this potential organization. Can you come down and match it? And I've had people that thank me and said, listen, I've used your charts just to say, so I can get a better price from the guy that I'm buying with. Because there's markup in there. But what's interesting is we're creating a platform, not just an order entry platform, but an affiliate program where individuals can become sort of referral partners, and they can refer people, and then we would pay them on the referrals. And that's marked up into that product structure right there. I mean, what this is basically looking at is a little bit above the wholesale market, and that's for a new product. But now that if you start to see a lot of sellbacks coming into the market, that's going to hit premiums even more. And this is part of the industry that makes me a little bit nervous about, is the industry which had made a ton of money the last 3 years, I think is in for some rough landing here, because as these sellbacks continue into the market, the brand new sovereign products and so forth, the mints, they may have to lower prices because they're not moving inventory. Wholesalers, which typically, they're not seeing much sellbacks because right now a lot of the retail dealers are absorbing a lot of this inventory to try and sell back into the marketplace to make a little bit of spread there. But in terms of the profit margins overall, I think bringing selling into the market will actually help the consumer, not the industry itself. And that's something that you want to know your counterparty, who you're doing business with, because as these profit margins come down, it's going to put a lot of pressure on their P&L. I mean, the cost of carrying inventory has only gone up because interest rates have gone up. And that's one of the reasons why the precious metals space has gotten kind of quiet. There hasn't been as much public demand because of that.
Now, you deal a lot with some probably bigger money clients through the hedge fund and through the storage. For some of the smaller players, right? Young kid in his 20s or his 30s wants to stack a little bit of metal, maybe he wants to do it at home. What would you say is a good place to start? He can't afford a 1,000-ounce bar. He's not going to buy a COMEX contract and take delivery, right? So he's going to go into the retail market and buy some metal. What is your favorite type of metal? Is it a sovereign? Is it an ASE? Is it a Canadian maple? Or is it the generic stuff? Is it rounds, coins, bars? What would you say is a good place to start?
Yeah, I tend to look for the lowest premium product, depending on what the client's looking for. You know, if you're living in a state like Utah or Arizona, for example, you know, the Eagles or U.S. Mint products have actually an advantage because they're state capital gains tax-free. If you're a UK citizen, for example, it's beneficial to buy British Britannias because they're capital gains tax-free. And so there's some nuances in some of these products that actually give it potentially some demand into the future. So if Britain, for example, we all watched the gilt market blow up last year. If they go through inflation first and all of a sudden you got this massive demand because their tax code says that the British Britannia is capital gains tax-free, guess what? Everyone's going to be buying British Britannias and the premiums are going to go up on British Britannias. We saw that even when the Queen passed away. The moment she passed away, premiums on all these, everything with her effigy on it went straight up. And so those are some nuances that you can look at, and that's what I try to counsel people on is, you know, look at these different products. They're not all the same. Even though silver is silver, there's maybe tax implications or some advantages that would separate the two. So rounds wouldn't have that beneficial advantage versus, you know, maybe a sovereign product. And again, selling sovereign products, you know, we're selling, you know, especially the last 3 years, we were selling sovereign coins cheaper than most dealers were selling 1-ounce rounds.
Okay, so that's how you'd get in. If you're in say smaller player in the market. What about getting out? A lot of people get into metals, they buy in, you know, they like the idea of stacking. They don't really have the exit strategy when they start. Again, small denomination, small bars, small rounds. How would you go about actually liquidating something like that? Say you do want to finally sell one. Local coin shop, sell to an online dealer. How would you go about that?
Yeah, definitely shop around. The depository that I manage and run and own, we can settle transactions in 15 minutes with a wire. I mean, we can move, you know, client wants to sell $100,000 in metal, we would buy it on the spot and then just wire funds or send them a check, whatever they prefer. But yeah, if you're definitely shop around. You know, obviously the local dealers, or in some instances, they may be better pricing than the online guys because the online guys may be up to their eyeballs in inventory. You're seeing that in today's market price. These bids are dropping. I mean, we're dealing with outfits, clients that have accounts with these sort of allocated programs, and they're storing over in Singapore, and they're wanting to get their metals out of there. Well, they have to pay $1.50 an ounce for shipping, or $2 for shipping because the logistics have gone through the roof. Well, then they say, well, that's too much. I'm just going to sell it. So then the program says, well, if you want to sell it, it's going to be $1.70 under spot, even though they're selling the same bar for $5.50 over spot. And so understanding these spreads and how they operate, treat this asset as more of an investment than an insurance policy.
Excellent. Anything else you wanted to talk about? Any of the other pitfalls in the industry that people need to be vigilant for and be on the lookout?
Yeah, I think one of the things that a lot of individuals out there that could benefit from is just shopping. Try not to. We've seen this a lot lately, but there's a lot of these dealers are probably going to start, if they're not already, bringing down prices. They may have specials because a client sells back inventory, and all of a sudden they don't want to be sitting on it. So they may post a special online or something of that nature. There's some good aggregator sites to watch out for. I don't know the names of them offhand, but what they do is they collect data and try to give you, okay, I want to buy a British Britannia, and they show you who has the best price from their aggregation of data. But definitely shop around. Try to listen to a lot of different individuals out there in the marketplace. There's a lot of smart people. I brought in, for example, this morning, we had a breakfast event. I brought in Steve St. Angelo from SRS Rocco Report. Wonderful presentation on how energy is going to affect the precious metals markets and maybe be an aid to the precious metals markets. But try to broaden that horizon of research and so forth, and give others opportunities, just so you can get a better perspective.
All right. Well, Bob, I want to thank you for taking the time to do this. Also want to thank you for all the heat that you took through the silver squeeze, being willing to stick your neck out and tell people things that they don't want to hear. It does take a certain amount of guts to do that, and I know you caught a lot of flack for it, so thank you for doing that. And I think this was good stuff. This is things that can help make people a more informed consumer, make better decisions. Again, there's nothing wrong with making money. When somebody sells you something, they're making money. Right? That's the whole point of selling things, is to make money, but it's knowing how they're making money, being upfront with where their interests are. The guy across the table from you is not your friend, right? He's selling you something. He's taking the other side of the trade you're taking. It doesn't necessarily make him your enemy, but your interests are not aligned, so know what his are, know how he's making his money, and this was an excellent way on how to do that. So I think Patrick is about to come on up. Thank you.
Yeah, guys, thanks so much, Bob and Jack. I'm going to take a question. One question, and then we're going to have Joe Brown come on and finish us up. Who's got a question? Anyone have a question for Bob?
Please have them put up on the screen the display they just had up there just a moment ago.
I think the charts.
Could
chart
you
of your
please
pricing.
have the chart put up?
Yes, thank you.
Which chart? The last chart. Can you guys put that on the screen? That was an easy question. No, thank you.
Do I hit
No calculus, please.
this one?
I think we need the...
You guys back there it is. Is that the one?
Okay.
There you go. Any other questions out there?
We've got one up front here? Right in front
I'm
of you,
sorry,
Patrick.
someone point. There you are. I'm sorry. The light's right in my eye.
Hi, Donald Morrison. How about transferring
Little closer.
transferring from one vault to another, like to transfer gold or silver that I have in another vault into your vault? Are there fees and whatnot, or just storage cost?
Yeah, for the transfer, the shipping side, you could either check with who you're currently storing with to see how much they would ship it. We can insure it inbound to our facility, so if they just wanted to ship it and you pay for the courier expenses. What we did as part of to try and help the community, First State Depository, which was probably the largest depository loss in U.S. history, which happened last year, about $116 million in losses. We paid for everybody who wanted to leave that facility. We paid the shipping to come to us. And so it was something we worked with the receiver on going back to October of last year. We're still trying to get people out of there, but it's something that the industry has to be able to help defer some of these costs, because otherwise this whole thing just turns into a money pit.
All right. I think that is our time.
There you go. Thank you, guys. Everyone, a round of applause for Jack and for Bob. Thank you.
Thank you.
Thanks, brother.
Thank you, bro.